Good morning and welcome to our live webinar, Generation Skipping Transfer, GST Tax, hosted by the Trust and Estate Department of PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop in the upper right corner. You'll have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. PowerPoint slides and a recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Mara Rabin, Director of our Trust and Estate Practice with PKF O'Connor Davies. Mara?
Thank you, Harleen. Hello and good morning. Thank you for joining us today for our presentation on the Generation Skipping Tax. My name is Mara Rabin. I'm a director in our Trust and Estates Department, and I work out of our Harrison office. Today's webinar is an overview of the Generation Skipping Tax, and will cover some general terminology, the current GST exemption, and some planning opportunities for minimizing GST exposure. Our speakers today are Christine Pronek. She is the partner in charge of our Trust and Estates Department, and Mani Gupta. She is a senior tax manager in our Trust and Estates Department, and they both work out of our Cranford office. Please enter your questions as available at the end of the program. We will try to address them, and if not, we will try to get back to you. And we hope you find the program to be enlightening and informative. So without further delay, I will pass this off to Mani for her to begin her presentation.
Thanks, Mara, for the introduction. Good morning, everyone. Thanks for joining us. My name is Mani Gupta, and today I'll be talking about Generation Skipping Transfer Tax, also known as GST tax. I presume we have a range of experience among our audience. Some of you may know about GST tax already, and for others, it may be a totally new topic. So for everyone's benefit, let's begin from the beginning, and we'll build on it as we move along. So like Amara introduced the agenda in the first segment, I'll talk about the general concept surrounding the GST, followed by the second segment where Christine Pronek, who's the head of our Trust and Estate Department and who I work closely with, she will go over the planning opportunities. So when you talk about the GST, you can't get away without mentioning about the estate and gift tax. So let's see, when do these estate, gift, and generation skipping tax come into play? The federal estate tax applies to transfer of property at death. Gift tax applies to transfer made while donor is living. And the generation skipping transfer tax, which is a topic of the day, is an additional tax on the transfer of the property made during life or at death that skips a generation. So what is generation skipping tax? Next slide, please. So the purpose of the GST tax is basically to capture the tax on transfers that skip a generation. The GST tax applies to direct skips, for example, if a transfer is made from a grandparent to a grandchild, as well as to indirect skips, which include the taxable distribution and taxable termination of generation skipping trust property. So let's look at the next slide. There is a picture, picture says 1,000 words. So assume there are grandparents, children, and grandchildren. If grandparents transfer assets to grandchildren, then the IRS has missed the opportunity to collect the estate tax on those assets in children's estate, if those assets had gone to the children first and then being transferred to grandchildren. So the GST tax is designed to capture that potentially lost tax revenue for the IRS, as it's exhibited in this illustration. So let me briefly mention a little history of GST. The US has taxed the estate of decedents since 1916. Gift tax have been taxed since 1924. And in 1976, Congress enacted the generation skipping transfer tax. So the GST was originally instituted in 1976. This initial GST that Congress created was criticized that the tax reform of 1986 retroactively repealed the 1976 version and implemented the current version, which is in still used now. Next slide, please. So to further build our knowledge on GST tax, it's imperative that we gain some understanding on these terminologies. These are very common terms used in GST world: skip person, direct skip, indirect skip, taxable distribution, taxable termination, inclusion ratio, to name a few. So let's take a look at what skip person means. So who is a skip person? Skip person could be a natural person or a trust. A natural person who is related will qualify as a skip person if it must be 2 or more generations below the donor, such as grandchild, great-grandchild, grandniece, nephews, etc. A natural person could be an unrelated person as well. And in order to qualify as a skip person, the age difference between the donor and the donee, or the transferor and the transferee, must be at least 37.5 years difference. That difference should be there. So to qualify that as a skip generation or 2 generations below. There is an exception to this rule. It's called the pre-deceased parent rule. A grandchild would not be a skip person in the event their parents dies before the gift is made by the grandparent. In that event, the grandchild moves to the parent's level. So it must occur, in order for this pre-deceased parent rule to apply, it must occur prior to the completion of the gift. If the completed gift is made to the trust and the child dies, pre-deceased parent rule does not apply. Moving to the next slide, let's throw some light on what is direct skip and indirect skip. Direct skip happens when a transferor gives asset directly to a skip person who will enjoy the immediate ownership rights. A trust could be a direct skip if it meets the definition, if both these conditions or either these conditions are applied. All the beneficiaries of the trust are skip person, or if the distribution from the trust cannot be made to a non-skip person, such as transferor's child. Let's look at the indirect skip. In indirect skip, the assets are transferred to trust, and both skip and non-skip persons are current and or future beneficiaries of the trust. For example, if a trust is set and in that trust there is children and grandchildren, both are the beneficiaries, that kind of arrangement is called indirect skip arrangement. Moving on, let's look at the next slide. So the GST exemption, which I'll talk shortly, it's automatically allocated to a direct skip. For the GST exemption to be automatically allocated to transfer made to a trust, the trust must meet the definition of a GST trust. So on a timely filed gift tax return, one can choose affirmatively to allocate the GST exemption, or can make an election opting out of automatic allocation to the trust if it's needed. So let's take a look what GST exemption means. Next slide, please. A slide before, yeah, that's right. As the name implies, the GST exemption provides relief from the GST tax. This exemption, it's an amount that can be directly transferred to the grandchildren or into the generation skipping trust for the benefit of the grandchildren without incurring a GST tax. Effective January 1, 2023, the GST exemption increased from 12.06 to 12.92, a significant increase of 860,000, and this number is adjusted each year for inflation. The gift and the estate tax lifetime exemption enjoys the same threshold as the GST tax exemption. It is also increased to 12.92 million from 12.06 per individual. This means between a married couple, they can enjoy 25.84 million of available exemptions of gift, and upon their death, up from 24.12 million in 2022. So GST exemption and lifetime exemption, they are the separate exemptions. available to the individual and not to be confused as one amount. They are two different pots having just the same number. So a point to be noted, in 2026, the GST exemption is scheduled to decrease to 6 million from 12.92. Adjusted to inflation, it will reduce to 6 million unless Congress intervenes. So it is hard to forecast, if that's going to happen. So this emphasizes the need for planning opportunities for utilizing the current high GST exemption before it decreases. And Christine is going to discuss further about these planning opportunities in the second segment. Next slide, please. Let's look at the GST tax rate. The GST tax rate remains a flat 40%. The GST tax is imposed in addition to any federal gift or estate tax that may be due on the transfer. Even though the GST tax is based on a flat tax rate, there are various nuances involved to calculate this GST tax, and we will look into it in further slides. Next slide. Let's take a look at the GST exemptions and rates over the years. Year 2000, the GST exemption was 1,030,000 and the GST tax rate against it was 55%. Next slide. A decade later, 2011, the GST exemption was 5 million with the GST tax rate dropped from 55 to 35%. 2022, it's 12 million and 60. It was 12 million and 60,000 with a GST tax rate of 40%. And like I mentioned earlier, in 2023, it's 12.92 million. The GST tax rate remains 40%. Next slide, please. Just a fun fact, if you're making a payment for education, tuition only, and medical expenses on behalf of a skip person, those are GST exempt, provided those payments are made directly to the provider. Just a small, fun thing to introduce. Next slide, please. So as I said, the GST tax calculation, it's a flat rate of 40%, and the calculation requires application of additional concept. It is not straightforward multiplying a number by 40%, and I'm not going to go over how it is calculated. That is our job to do it for you. What I'm going to go over is to briefly introduce these concepts to you so you are somewhat familiar about it. Next slide. Let's look at one of the, when you calculate the GST tax, these are some common terms that comes into play. Taxable amount. The taxable amount is determined differently for direct skips, taxable distribution, and taxable termination. Direct skips, the taxable amount net of annual exclusion, that is the value of the property received by the recipient as of the date of the transfer. For example, a grandfather gifted $1 million cash to granddaughter. The taxable amount will be 983,000, 1 million less 17,000 of annual exclusion. For taxable distribution, so taxable distribution is a distribution from a trust that does not have an inclusion ratio of 0. We'll go over the inclusion ratio briefly soon. So it is a distribution which is made from a trust to a skip person, and it is not a taxable termination. Next slide. So the taxable distribution is the value of the property which is received as of the date of the transfer, reduced by any expenses incurred, and increased by the amount of GST tax paid directly by the trustee. Let's take a look at this example, which clarifies the position. Grandparent creates a trust providing for a distribution of income or principal to child or grandchild in trustee's discretion. Any distribution to the grandchild is a taxable distribution, provided if the inclusion ratio is greater than 0. No distribution to the child, however, whatever so is made, would be considered as a taxable distribution. So moving on to the next slide, let's take a look at what taxable termination means. Taxable termination is the value of the property in the trust as of the date of the taxable termination occurs, reduced by any expenses, debt, or any taxes attributable to the property. For example, a grandparent leaves property in trust for daughter during her life, and the trust provides that the property passes to daughter's children, who are the grandchildren to the transferor, at daughter's death. So this event will happen at daughter's death, property passing to the grandchildren. The taxable termination will occur at the daughter's death if there are no more skip beneficiaries of the trust, non-skip beneficiaries. The creation of the trust does not trigger the GST tax. So when the trust was created, that event does not trigger the GST tax because there is a potential that daughter could have used all the property during her life, leaving nothing passing to the grandchildren. Next slide, please. Let's talk about the inclusion ratio. Inclusion ratio is the key to GST on transfers in trust. Every trust, direct skip, has inclusion ratio, which determines the portion of the trust or direct skip transfer subject to GST tax. So an inclusion ratio of 0, it means all distribution from the trust are exempt from the GST tax, and an inclusion ratio of 1 means that all distribution from the trust are fully subject to GST tax. And there could be a mixed inclusion ratio that range between 0 and 1. And advancing to the next slide, let's take a look at this example. Transferor makes a taxable gift of 1 million to a trust for benefit of a child for life, with the remainder passing to grandchildren. The transfer is not currently a GST taxable transfer but will result in a taxable termination upon the death of the child. We talked earlier about the taxable termination. The transferor allocates 1 million of GST exemption to the trust at the time of the transfer. So what it does, it makes the inclusion ratio for the trust to be 0, and hence it is entirely exempt from the GST tax. Moving on. So just a planning tip, effective GST planning would provide that separate trust may be created, and what it will do, it will enable a trustee to distribute property that is not exempt from GST tax to non-skip persons and to reserve the GST exempt property for distribution or possible distribution to skip person. It's a better management of the GST exemption that's available to you. Moving on, let's take a look, if there in an event there's a GST tax there, who pays this GST tax? Generally speaking, if it is a direct skip, the GST tax is paid by the transferor. If it is a taxable distribution, the GST tax is paid by the recipient, and in an event of taxable termination, generally speaking, the GST tax is paid by the trust. So let's take a look at another slide. So where does this GST exemption allocation, where do you see this, where it's reported? The GST exemption allocation is reported in either of the two forms. It could be Form 709, which is your gift tax form, or Form 706, which is your estate tax form. So when the transfer is made inter vivos, that means during the lifetime, the allocation is reported on Form 709. There is a Schedule D Part 2 of Form 709 where we show the exemption which is used, and I don't know whether it's visible clearly. The last line, line number 8, after deducting the exemption used, that line shows which is exemption which is available to the individual for future transfers. Next slide shows about Form 706. So on Form 706, there's a Schedule R that should be filed to allocate the GST exemption to the trust that may later have taxable termination or distribution, or the Schedule R can be used when there is an outright testamentary direct skip transfers made. So those are the two places where you can put the GST exemption allocation amount. Moving on. So let's talk about portability. That's as some of you may be aware, unlike where the IRS allows for portability of lifetime exemptions between spouses, which is an important consideration in estate planning, any GST exemption, if it is unused at one spouse's death, it cannot be carried to the surviving spouse. So lifetime exemption can be portable depending upon your facts and circumstances, but GST exemption can never be carried to the surviving spouse. So either you use it on your 709 or 706 form that we briefly talked earlier, or you lose it. So it's use it or lose it situation. There is no portability for unused GST exemption. Moving on, let's talk briefly about the GST annual exclusions. So GST annual exclusion is applicable to transfers that are direct skip to natural person, or if they are gifts made to the certain trust. The GST annual exclusion for year 2023 is 17,000 for each recipient, and is adjusted for inflation every year. So advancing to the next slide, let's take a look at some of the examples. I mean, it's just to like recap what we learned. So let's take a look at the example of taxable termination. Suppose there's a grandparent who gives $500,000 to a trust that benefits his son and 2 grandchildren. The grandparent allocates $500,000 to the trust, son then dies, creating the taxable termination. Son's death would otherwise trigger a taxable termination subject to GST tax. However, because the grandparent allocated the GST exemption equal to the amount transferred to the trust inclusion ratio is 0, and the termination of son's interest in the trust as a result of the death does not trigger GST tax. So what if somebody transferred 500,000 during their lifetime, and then that 500,000 grows to 2 million? At the time of the transfer, say they have opted for the GST exemption allocation. So now that the amount became 2 million, so what about the 1.5 million? Will there be a GST tax consequence on that growth? Next slide. So the generation exemption allocation at the time of funding also covers any future growth and appreciation in the trust. So that 1.5 million growth, there will not be any GST tax consequences provided the GST exemption was allocated to the original transfer made at the time of the transfer. So what it emphasizes is, again, the same point. You have to plan now, make use of the available 12.92 million, which is the current threshold, before it may sunset to 6 million by the end of 2025. So this concludes the first portion of the presentation. I have touched only a tip of an iceberg, but hopefully shared enough or set a ground for us to have a platform for future discussions. Please feel free to reach out. We'll be happy to collaborate with you, your attorneys and advisors. And again, thank you for your time. In the next section, Christine is going to share some important planning opportunities surrounding the GST. Thanks again, and over to Christine.
Thanks so much, Moni. Good morning, everyone. Thank you for joining us today. Now that Moni's given you an overview of GST tax and what it is and the exemption, I'm going to get into some planning opportunities with the exemption. Next slide, please. So to start, the first thing I want to mention, and Moni had it on her slide as well, is use it before you lose it. Right now, the exemption is the highest it's ever been. It's $12,920,000. It is scheduled to sunset at the end of 2025. And so as of January 1st of 2026, we could have an exemption amount as low as, say, $6 million adjusted for inflation. An important thing to keep in mind is that as you utilize your GST or use your GST exemption, it's not coming off the top. It starts from the bottom. So for some, I've had this question several times. With the $12,920,000, what's going to go away at the end of 2025 is that top 6 million, let's call it. So for you to really utilize the piece that you could be losing in a few years is you need to do above the 6 million of use of GST exemption use and get into that second half up to the 12,920,000. So as an example, right now we have the 12,920,000. If you've utilized 5 million of your GST exemption, and that's all you've done by the time it sunsets and we get into 2026, and let's just say the number is 6 million flat, you have 1 million of GST exemption remaining because you have your 6 million that it dropped to and the 5 million that you utilized. So what you want to do, and obviously it's only if you've got the assets to be able to do it, is to go all the way through and use that 12,920,000 so that you fully utilize that excess that we have before it goes away. The other things that I'll be talking about are timely allocation of GST exemption to new trusts. You can utilize your exemption through GST allocation to irrevocable life insurance trusts, ILITs, and I'm going to be talking about that especially because we see a lot of problems with that particular type of trust and a misunderstanding on the GST side and some messes that get created. So I'm going to have a little bit of a discussion on that and issues that we've seen and things to look out for if you should happen to have an ILIT, just to make sure it's being properly monitored from the GST side. And then lastly, I'll talk about an opportunity for late allocation of exemption to existing trusts. So while we've got this big GST exemption of $12,920,000, if you have some existing trusts that don't have the zero inclusion ratio, meaning that there would be some GST tax on a taxable termination or a taxable distribution, we have an opportunity to take some of that GST exemption and allocate it to those trusts to cure them, let's call it, to get them to be fully GST exempt. And I'll be discussing that as well. Next slide, please. So for timely allocation, and this is just a quick, simple example, when you set up a trust and you have, it's going to reach further generations, meaning you've set it up for your children and your grandchildren, you know there's the possibility it's going to go on to a skipped generation, being the grandchild's generation and beyond. You set up the trust, you file the gift tax return, the contribution to the trust is then fully covered with GST. An allocation of GST exemption is made to that transfer on the gift tax return. So in a simple example, I contribute $8 million to a trust that I've established for my kids and grandkids. I, on my gift tax return, allocate $8 million of GST exemption to it. I now have a trust that has a zero inclusion ratio. It's not going, when there's a distribution down the road to a grandchild, there's not going to be GST tax assessed on that because I've covered the trust fully with GST exemption. That trust and that exemption, because I did this as a lifetime transfer, it's going to cover the growth of that as well. So I've contributed 8 million. Let's say 5 years from now, the trust is worth 20 million. The entire 20 million is covered because I covered the transfer to the trust fully at the time the transfer was made. And it's important to note, this isn't just the initial contribution that you have to cover. Any contributions I make in the future to that same trust, I would want to cover that contribution amount on my gift tax return with GST exemption. Make that timely allocation and continue to keep that trust fully GST exempt. Next slide, please. So one example of a popular trust right now, it's been for a while, are these trusts called SLATs. They're spousal lifetime access trusts. And the beauty of the SLAT is with this high exemption and people doing a lot of planning to take advantage of it before it goes away, this is on the gift tax side as well. They've been using these trusts because while it's great to be able to fully utilize that 12,920,000, it's also a little daunting to someone to even just, no matter how much you have in wealth or assets, when someone says, hey, let's make an irrevocable transfer of almost $13 million of that, you could easily say, well, I'm not sure I want to do that. It sounds a little scary. But with these SLATs, having a spouse as a beneficiary of the trust, there's an opportunity for money to come back through a distribution to the spouse, basically an escape hatch. That if, let's say, you fund one of these trusts, you put your full exemption amount in it, and now years down the road, circumstances change, and now you need some of that money back. Like at the time you contributed it, it was fine to do it. Something happened, as I said, your circumstances are different, you want to get some of that back. That can come back to you through distributions out to the spousal beneficiary that's in the trust. Now, granted, while it is a great escape hatch and it affords that relief of knowing even on an irrevocable transfer, you could still get it back if you needed to, you of course don't want to do that because you've used some of your exemption to establish that trust and to get it outside of your estate. So by turning around and then pulling it back into the estate, you've wasted the use of that exemption. But if the circumstances are such that you need to do that, at least you have the opportunity with that spousal beneficiary. And these type of trusts are typically, they provide the cash flow to the beneficiary. They're usually set up for the spouse and children, and then can go on to issue, further generations. They're still going to be outside of your estate upon your passing. The other little kink in the plan, which can be resolved with life insurance, is, okay, what if you set up a SLAT and now the spousal beneficiary passes away? Now that escape hatch is gone. You don't have that ability to get distributions out to your spouse back to you because the spouse is no longer there. Life insurance on that beneficiary spouse can be used to kind of mediate that concern. And to get to the GST side of it, if this trust is set up to go for children and beyond, you can allocate GST exemption to the transfer made to the trust on your gift tax return. And so now you've also set it up for GST exempt purposes as well. So those future distributions to grandchildren and beyond will not be subject to GST tax. So now it's out of your estate, it's covered for GST, it's an irrevocable transfer, but if something should go wrong and you need to get something back, there's distributions that can be made to the spouse. Next slide, please. Timely allocation of GST exemption to Dynasty trusts. These trusts are in particular very important for GST exemption allocation. They're established to go on for generation after generation after generation. They're set up to exist for the longest period of time possible. And right now, depending on what state law is applicable to the Dynasty trust that you establish, you're going to fall into one of three buckets. Some states are following something called the rule of perpetuities. Under the rule of perpetuities, that trust can exist until 21 years after the death until 21 years after the last to die of all the identifiable beneficiaries at the time the trust was established. So if you set it up and right now you have kids and you have grandkids, that's the picture that's going to be looked at to say, okay, all of those people, those kids and those grandkids, 21 years after the death of the last to die of all of them is when that trust must terminate and must be distributed. So that's for rule of perpetuities. New York follows the rule of perpetuities, just as an example. Another bucket, depending on what state is governing, is state of New Jersey. Excuse me. Another bucket is states that are not acknowledging rule of perpetuities. They've abolished it. They will let these dynasties trusts go on and on and on with no limitation. And I skipped ahead. The state of New Jersey is a state that does allow that. And then there are some states that have carved out a special rule with respect to dynasty trusts. So they're not following rule of perpetuities, but they haven't completely left it open to go on forever. They've actually chosen terms of years that these trusts can continue to go on for. Two examples will be Florida, I believe, has 360 years. The state of Ohio allows for 1,000 years. So I'm not sure how the numbers were determined, but there are different rules depending on the state law that's governing the trust. But basically, these dynasty trusts are set up to go on for generation after generation after generation. So of course, you would want them to be fully GST exempt, have a zero inclusion ratio, cover the transfers that are made to the trust with GST exemption allocation. Let's see, and because the trustee of the trust has the discretion to make distributions of income and principal to the beneficiaries, these trusts will also, as other trusts, offer marital and creditor protection. So for all its generations after generations, you protected these assets from divorce, you protected them from creditors, and most importantly, you protected them now from gift and estate and GST taxes. You covered it with GST exemption, so GST tax won't apply to any of the distributions, and this trust will be outside of the estates of those future generations, not to mention outside of your own because you've made this irrevocable transfer to the dynasty trust. So it's a great vehicle, basically a legacy type trust set up to help generations for as long as possible. As I mentioned earlier, if you fund this trust during your lifetime, not only would you be covering the amount of the transfer into the trust at that time, but now you've covered all the future appreciation. This type of trust can also be set up upon your death. You could have provisions in your will that will establish and fund a dynasty trust and covered with the remaining GST you have upon your passing. Next slide, please. Now, the irrevocable life insurance trusts. These trusts are set up to own a life insurance policy on either the life of the grantor or the life of the grantor and the grantor's spouse. But basically, it's to get that life insurance policy outside of your taxable estate. Because given the face value on most policies, that's a fairly large asset that you don't want to have in your hands and subject to estate tax upon your passing. So you have one of two options. You can either take an existing policy and transfer it to the ILIT, to your irrevocable life insurance trust, or you can transfer cash, gift cash into the trust, and then the trust will pay, or the trustee will purchase a life insurance policy and pay the premiums on it. One thing to note, if you transfer an existing policy, then there is a rule that states that grantor will need to live 3 years after the date of that transfer of the policy to avoid having that pulled back into the grantor's estate. So you want to get past that 3-year mark. Typically what's done is the trust is established and the grantor contributes cash, and then the trustee uses that cash to pay the premiums on the policy, and it goes forward from there. And the way that a lot of these are established is that they have something called crummy withdrawal rights. Crummy is just the name of the taxpayer that the court case was based on, but the withdrawal rights state that beneficiaries in the trust have the right to withdraw contribution amounts that, as you know, currently when they're made, up to the limitation of the current annual exclusion. So right now we have an annual exclusion of $17,000. The beneficiaries of the trust can withdraw up to $17,000 each if these crummy withdrawal rights are in there. So as an example, right now with the $17,000 exclusion, if I had a trust that had 5 beneficiaries with crummy withdrawal rights, I could put in $85,000, and then I can contribute $85,000 to the trust, and I would have my gift tax annual exclusion covered, that's $17,000. But what's important to keep in mind is doesn't have the GST tax annual exclusion coverage. And Monty mentioned this earlier. The gift tax annual exclusion of $17,000 is fairly easy to meet. It needs to be a present interest. That beneficiary needs to have a current economic benefit. And these withdrawal rights create that. They can reach in and take that money if they wanted to. So that's a present interest, and I get to utilize the annual exclusion for that. The GST annual exclusion in a trust is much more difficult to meet those terms because it has to be for one skip person, has to be includable in that skip person's estate upon their death. It's much more restrictive. So with these ILETs, I've met the GST gift tax, I've met the gift tax annual exclusion requirement, but I don't have the GST tax annual exclusion requirement met. So when I contribute my 85, I don't have a gift tax concern, but I still want to address the GST concern. And I'm going to get into that more in a bit. But that's where the distinction is on those trusts. The annual exclusion being that there's two different ones, gift and GST, you need to be paying close attention to which one applied and which one didn't. And most ILETs are drafted to meet the definition of a GST trust, which Monty discussed earlier as well, which means that they qualify for an automatic allocation of GST exemption. So without me even making an affirmative allocation on my gift tax return to the ILET, it's going to be covered automatically under those GST automatic allocation rules. And in my opinion, best practice is to file a gift tax return each year, make a definitive record of it, state the transfer that was made, and make all and cover the allocation. But I'm going to talk in a minute about the options that you have there. Next slide, please. So an important question to ask when you're funding these irrevocable life insurance trusts is, do you want that trust to be covered for GST purposes? It's entirely possible that you're thinking that trust isn't going to reach grandchildren, so you don't want to use your GST exemption on it. The other possibility is you have other trusts, such as maybe you fully utilize your GST exemption on a Dynasty trust, so you don't want any of that to be going towards an ILET, or you intend to put it on a Dynasty trust, so you don't want to use any of it on this ILET. If the answer is no, that you do not want to have your irrevocable life insurance trust covered with GST exemption, then what you would want to do is file a gift tax return to opt out of the automatic allocation. Because as we mentioned, a lot of these ILETs are drafted to be a GST trust, which would get automatic allocation. So if you don't want that, you want to file your gift tax return to effectively opt out of it. Because if you don't, and you just make your contributions to the trust and you figure, well, I'm good because I know I've got my crummy rights, so I don't have to worry about on the gift tax side, I'm covered, so I'm not going to file the gift tax return, then what you have going on in the background is an automatic allocation of your GST exemption to the contributions you made to this trust that you don't really want to have your GST exemption used for. So in my case, if I contributed $85,000 to an ILET and didn't bother filing my gift tax return because I know I've got my 5 crummy beneficiaries, I know I didn't have any taxable gifts, they're going to be they'll utilize the annual exclusion for gift tax purposes, I'm going to have $85,000 of my GST exemption automatically allocated to that transfer just because the trust was designed as a GST trust and it was afforded automatic allocation. So again, if you don't want that allocated to your ILET, we want to file the gift tax return and we want to opt out of the GST automatic allocation. And you also want to opt out of having it treated as a GST trust. And both could be done either for current transfers or current and future transfers. And if you've decided you never want to have your GST exemption on it, it makes sense to make the opt out of current and future so that that's taken care of. So then the other alternative is, yes, you do want to have your ILET covered with GST exemption. And the concern there is, okay, so it's been drafted as a GST trust. It should have the automatic allocation occurring to it. But rather than just assuming and relying on that, what we would recommend is you file your gift tax return, you show the transfer to the trust, and then we make elections to affirmatively elect to have the trust treated as a GST trust, even though it was understood to be drafted that way, and also to make an election to have the automatic allocation rules apply. Now, let's just call it belt and suspenders. We know we've made these elections. We know that's what's going to happen. When you make contributions to that trust, the automatic allocation of GST will take place. So those types of elections would be what we would make on the gift tax return to make sure that's all covered. Now, having done that, and whichever, like let's say we've got the scenario where we want the GST exemption allocated, and we've set it up to have auto allocation for current and future year transfers. We've basically put it on what's called an autopilot. So the thought there is a lot of clients say, all right, well, if it's on autopilot, I've got my GST exemption automatically happening. I've got enough primary beneficiaries that I know I'm not going to have any of my lifetime exemption utilized because my gift annual exclusions cover it. I don't want to file a gift tax return if I'm not required to. It costs money. I don't want to do it. I don't want to be bothered with it. That's an acceptable solution, assuming you have no other reason to have to file a gift tax return. But then what you need to do is track the automatic allocation. Because in my case, let's say I filed my initial year, I made all my elections, I want my 85 to be automatically allocated each and every year, or excuse me, I want GST exemption to be allocated to whatever I contribute each and every year, and I'm going forward on quote unquote autopilot. I would still need to keep track of the contributions that I make each year because that amount did have automatic allocation. And at some point in time, whether it be the next time I do have to file a gift tax return or upon my passing, it will need to be known how much GST exemption do I have left. So if that hasn't been kept a record of, no one's going to know, and they're going to be going back in time to figure out what were all the transfers, and let's go from there and add it up and figure out how much exemption is remaining. So even if you've got an islet that you don't want to have to file gift tax returns for every year, you should still let your accountant know how much of a contribution you made each year so that they could be separately tracking the amount of GST exemption that was automatically utilized. I see this all the time with ILETs. Most frequently, we get a new client, they come in and they say they've got an ILET, and we'll start asking questions. Well, what gift tax returns have you filed? What elections have been made? What's been done here? And there's several different problems that could pop up. One is, okay, the automatic allocation is happening, but they haven't kept track of it. All right, let's get a scheduled premiums from the insurance company and figure out how much was used. The other could be, they're not sure if the automatic allocation is applying because the elections weren't made. Then we have to take a look and see if it did qualify as a GST trust. Or the other problem is they never opted out and the GST trust definition was met and auto allocation was happening. Now they've used a bunch of GST exemption on a trust that they never wanted to use it on. So the best we could do in that case is file a gift tax return, opt out on it at that point, and at least stop the waste of the GST exemption on future transfers. But there is a lot to think about with respect to, I'm using this as an example because I see it most often with ILETs because people seem to think, well, I've got the crummy withdrawal rights, I'm all set, I'm good to go. And they forget about the GST side of what's going on with that trust. And the elections that I've mentioned, the automatic allocation or to treat it as a GST trust for current and future years, they can be terminated in a future year. You can turn that election off if for some reason you decide you want to. Next slide, please. This is just getting into the specifics of automatic GST exemption allocation and the different elections that are available on the gift tax return. It's on the slide, but I won't go through the different options. As Monty said earlier, that's up for us to do for you, but the information's on the slide. Next slide, please. And same thing here, various ways to make elections with respect to the trust being treated as a GST trust. Next slide, please. Okay, so late allocation of GST exemption. This is another opportunity to utilize this high exemption amount that we have right now. Let's say the first example I'll go through is a trust that you have that's in existence that you've never allocated GST to. And let's say it didn't have automatic allocation going on. It's not a GST trust. So now we know we have an inclusion ratio of 1. It's fully subject to GST. Any transfer that comes out of that trust to a skip person will be subject to that 40% GST tax rate. And if maybe at the time you established it, that's what you wanted, you intended it to not reach grandchildren. Now planning has changed or circumstances have changed and you'd like to cover that trust, give it a 0 inclusion ratio and have it fully covered so that as distributions come out to grandchildren and beyond, you don't have the GST tax. We can make what's called a late allocation. And how that's handled is you would take that trust, it would have to be currently valued. So there could be appraisals involved, there's some fees and some extra work, but the value of the trust would have to be determined. And then we take a look at how much GST exemption you have to cover it and see if it can be fully covered. If the value of the trust is 8 million and you have 8 million of GST exemption that has not yet been utilized, it's fairly straightforward. We can file a gift tax return and make a late allocation to cover that trust with the 8 million. So now it's fully exempt from GST purposes and all the growth going forward will be covered. In a little trickier circumstances, it's the value of the trust is higher than the amount of GST exemption that you have to allocate to it, but you at least want to get some part of it covered. There can be a partial allocation to the trust, but how it's handled, well, let me correct that. You don't want a partial inclusion ratio. The trust can be severed so that you have one bucket that you have enough GST exemption to fully cover, and then you have the other bucket that won't be covered at all. So the severance, obviously, we would be getting an attorney involved. The trust is basically split into two. The new trust has all the same terms of the existing trust, but we've split apart value so that we could fully cover one bucket and not cover the other. So in an example, let's say you have $10 million value of trust, and you have, well, let's just say it's a $15 million value trust. You have all your GST exemption remaining, the 12,920, but that's not obviously going to cover 15. So you need to have a severance of the trust. So now you have 12,920 remaining in the one bucket. The rest went over to the other. We allocate the 12,920 to that trust. That's fully exempt from GST tax now and going forward. And the other trust is fully exposed to it. It has no GST exemption coverage on it. But at least you've got some part of it covered instead of an entire trust with no coverage. And going forward, what you would want to do there is if you have children and grandchildren in the trust as beneficiaries, in the trust that has no GST coverage, it's fully exempt to the tax, make distributions to your children from that one. Because you wouldn't want to use the GST covered trust for distributions to children. You'd want to try to preserve that for distributions to the skip people. Make distributions to the children from the non-covered trust, at least until it's exhausted. And then if that's fully depleted and you still want to make distributions to the children, then make them from the GST exempt trust, but obviously start with the non-exempt one first for the kids. So a severance can accomplish that. Another way to accomplish solve the problem would be distribution. If it made sense under the facts and circumstances, and let's say in my example, you have the $15 million value trust, you have 12,920 to apply to it, you can distribute the excess over the 12,920 to the children to get the value of the trust down to the amount that you can cover with GST exemption. It would all depend on whether or not that makes sense. You know, as I said, facts and circumstances, but two different ways to get around the problem of having more value in a trust that you want to cover than you have GST exemption to work with. And there's a tricky little thing, but this is more on our end for the gift tax return. Trying to value the trust and then immediately cover it with late allocation. To do it on the same day is, let's just call it impossible, right? Is what it is. So they do allow for an election where you can value the trust as of the first day of the month, but then within that same month, you need to file the gift tax return. You need to make the allocation before the end of that month to have it all considered I guess, a timely late allocation, if you could call it that. So value it at the first of the month, get the return in before the end of that month, and now you've covered a trust that previously was not covered for GST, and you've utilized the exemption before it goes away. And next slide, please. Another example would be if you have a trust that right now has a partial inclusion ratio, meaning it's not 0, it's not fully exempt from GST, but it's not 1 either. It's not completely exposed to GST. You've got this in between. Again, you can make a late allocation to that trust. The mechanics of it is are just a little trickier in determining what that inclusion ratio is, looking at what the inclusion ratio was every time a prior contribution was made, and then coming up with the amount that needs to be contributed to get that inclusion ratio all the way to 0, to full coverage. And similar to the first example, this could be done through distributions or severances to try to what they call cure that trust and get it from a partial inclusion ratio to an inclusion ratio of 0. Because with a partial inclusion ratio, anytime a distribution is made to a skip person, you have to take that inclusion ratio times what was distributed times the tax rate to figure out the amount that has to be paid. Each time, you'd still have some taxable portion of the distribution. And of course, you'd rather have them be clean, get to the inclusion ratio of 0 and not have to worry about that 40% GST tax applying to distributions to the grandkids. Next slide, please. Okay, so qualified severance. Before I get into the details of this, because this is really, this would be more, it's on the legal side, the attorney would be involved, they'd be severing the trust. As I mentioned before, the new trust has the same terms as the original trust. It's not an opportunity to change terms around or to decant. It's just taking one trust and splitting it apart so that you can get part of it covered fully for GST purposes. Another opportunity besides late allocation is the IRS does offer relief for late allocation, for basically missed allocations of GST. If you've got the right facts and circumstances, you can apply for a private letter ruling with the IRS, which does have a fee involved with it. I think it's around the $9,000 or $10,000 range for this type of PLR. You'd file for, you'd request a private letter ruling from the IRS, explain to them you've got a trust that's not covered with GST, that you meant to have covered with GST, give the facts and circumstances for why it wasn't covered, and ask them if they can grant you late allocation relief. The reason for if it made sense based on the circumstances to go for this, if you get the late allocation relief from the IRS, instead of covering that trust, the value of the trust, like when I gave my example, you have an $8 million trust, you have $8 million of GST, we can use that and make a late allocation. Instead of that, if you get the relief from the IRS, you can actually cover the amount of the contribution that had been made as opposed to the value today. So if I had a trust I created 7 years ago and I contributed $1 million to it, and now let's say it's grown to $9 million, if I did a late allocation on my own without asking the IRS for relief, I would need to use $9 million of my GST exemption to get that trust fully covered. If I applied to the IRS for the relief of a late allocation and they grant it to me, I'll be using $1 million of my GST exemption because I'm covering the transfer that was made at the time of the funding. So it's worth going for if you think you've got the facts and circumstances where the IRS will actually grant you that relief. So just another option to keep in mind. We don't have to automatically jump to late allocation. We can look to see if it makes sense to ask for relief and try to use much less GST exemption to cover a trust that wasn't covered than we would have to use to do the late allocation. Next slide, please. And next, I think the rest of them was just going through qualified severance. That's just the terms and conditions for doing a qualified severance, which again is a legal matter. We'd have an attorney involved. They'd be doing that work on the trust side, and then we'd be doing the allocation on the gift tax return side to say, all right, now we've got one clean bucket and one that's exposed, and go forward from there. But each of the things I discussed are a great opportunity to use this high GST exemption before it goes away. And the other point we wanted to get across was just please pay attention to those irrevocable life insurance trusts. Because in addition to one of the problems being that we get a new client and now we're looking at things they've had and finding out there's issues, we have some existing clients that just have never mentioned that they have an irrevocable life insurance trust. It somehow comes up in conversation one day, and then we're going back and playing cleanup and trying to make sure that trust is operating the way it should be on the GST side, either opting out to stop the auto allocation or making affirmative allocations to make sure we've got it. But do pay close attention on those life insurance trusts to the GST aspect of them. Thank you so much. I'm going to kick it back over to Mara. I don't know if we have a few minutes. Do we have any questions, Mara?
Trying to turn my camera back on. Got a few questions. There it goes. So I think this first question is for you, Monty. Does the lifetime exemption and the GST exemption in total equal $12,920,000 for 2023?
So the answer to this will be no. As I mentioned during my presentation, the exemption of 12.92 are separate exemptions for lifetime as well as GST purposes. These are two separate exemptions available to an individual, each worth 12.92. So they are separate buckets. Just to note, lifetime exemption may be portable, but GST is never.
Thank you. There's one here. Well, I think this is for you, Christine. If I have an IRA, is it okay to pay the premiums directly to the insurance company, or should I contribute the money to the trust?
Oh, thank you. Good question. That's another thing I actually didn't touch on the GST side. Very often with irrevocable life insurance trusts, the grantor of the trust just writes the check directly to the insurance company. It's better and it's preferable. Let's call it best practice. Contribute the money to the trust and then let the trustee write the check to the insurance company. We see it very often that the middleman being the trust gets cut out, but it does make sense, or it's better to contribute the money to the trust and let the trustee pay the insurance company. Thanks.
And Monty, there's another question for you. Is the GST annual exclusion always available to reduce the GST transfers and the GST tax?
Sorry, I have to turn my camera off. It was acting weird. So answer to your question, Mara, no. In limited circumstances, a GST exclusion is available. So most gifts which are made through the trust do not actually qualify for the GST annual exclusion.
And another one for you, Christine. How do I find out what GST coverage my existing trust have?
Oh, okay. If you'd like to have an analysis done of your trusts, it would involve looking at the trust documents themselves to see if they look like they qualify for a GST trust. Preferably, we have the attorney that drafted the opine on that. I'd look back at gift tax returns that were filed from when the transfers were made to see what GST elections or allocations were done. And between those two pieces, figure out, okay, how much of this is covered, if anything, and get to the conclusion of, so where do these trusts stand today? Are they covered? Are they not covered? Are they partially covered?
Oh, great. Monty, I have another question here. It looks like it might be something for you.
Sure.
What does timely filed gift tax return mean for the purposes of the GST exemption allocation?
Good question. So timely filed means, it should be submitted by its due date. So the gift tax return due date is 4/15. Unless it is put on extension, then it becomes 10/15, October 15th. So it means it should be submitted by its due date, including any extension. Then it would be considered timely filed.
I think that's about all that we have time for now.
Okay. And I think for anyone whose questions we didn't get to, or if there's more that are going to trickle in, we will be getting back to you. We'll have a summary of those questions sent to us, and you will be getting our responses. I will say in advance for anyone who might have asked a question that's for me, I'm on vacation next week. Yay! So you may not get a response from me for about a week or so, but that's why. It'll just be a bit of a delay because of vacation. But thank you so much for attending. We appreciate your time and your attention. I'm going to kick it back to Harleen. Were there any wrap-up things at the end, Harleen?
Yes, there is. Thank you so much, Christine, and thank you to all of our speakers and everyone else for attending. Please remember to complete the short survey prompted at the close of this webinar. Again, a recording and PowerPoint slides will be made available to all attendees via email within the next few hours. Thank you again and have a great rest of your day.